Welcome to The Explainer. Today, we're going to tackle one of the most fundamental, yet, often misunderstood parts of the financial world, bonds. Think of them as the silent workhorse of a really smart investment portfolio.
So let's just start with a question. As you're thinking about your financial future, are you looking for a way to kind of smooth out those wild rides of the stock market? A way to add a layer of stability? If the answer is yes, well, you are in exactly the right place.
Here's the roadmap for this explainer. It's pretty simple. First, we'll cover what a bond actually is. Then, we'll get into how they work, check out the different types, weigh the pros and cons, and finally, figure out where they might fit into your own game plan.
Okay, let's dive into our first section and get right to the core of what a bond really is. And I promise it's way simpler than it sounds.
Honestly, you can forget all the complicated Wall Street jargon for a second. At its heart, a bond is just a loan. It's a formal IOU. So when you buy a bond, what you're really doing is lending your money to an organization, and in return, they're giving you a promise to pay you back.
Now, this IOU comes with two very clear, legally binding promises. It's not just a handshake deal. First, they promise to return your original investment, that's called the principal, on a specific date down the road. And second, as a little thank you for letting them use your cash, they'll pay you regular interest along the way.
Okay, so how does this IOU actually work in the real world? Let's walk through a quick example to see exactly how it puts money in your pocket.
So let's imagine you buy a bond for $1,000. That's your initial investment, right? That's the amount you're lending. In the bond world, we call this the principal.
Now, this bond has a 4% coupon. That's just a fancy term for the annual interest rate the issuer agrees to pay you for borrowing your money. And here's where it gets good. That 4% coupon on your $1,000 principal, well, that translates directly into $40 of income for you every single year. It's a predictable, steady stream of cash.
And finally, there's the maturity date. If this is a 10-year bond, it just means that at the end of those 10 years, the loan is all paid up and you get your original $1,000 back. In full. Simple as that.
But wait a minute. What if you need that $1,000 back before the 10 years are up? Well, you can almost always sell a bond early on the open market. Just know that its price might have changed. It could be worth more or it could be worth less than what you paid, all depending on what's going on with interest rates in the economy. So who exactly are these organizations borrowing all this money? When you buy a bond, who are you really lending to? Let's take a look at the main players.
Well, there are a few major types. You've got government bonds, like U.S. Treasuries, which are considered super safe, so they tend to pay a little less interest. Then there are municipal bonds, which are issued by states and cities to fund things like schools or bridges, and they can sometimes come with nice tax breaks. Of course, you also have corporate bonds, which companies issue to raise money. They've got a bit more risk, but they offer better returns. And finally, you have high-yield bonds. You might have heard them called junk bonds. They offer the highest potential returns for a reason. They also carry the highest risk that the company might not be able to pay you back.
All right, so we know what bonds are and who issues them. Now for the really crucial part. What are the trade-offs? Let's look at the pros and cons of actually putting your money into them.
And this really gets to the heart of it, doesn't it? On the pro side, you get that awesome stability, a predictable income, and a great way to protect your initial investment. But on the con side, well, that safety usually comes at a cost. And that cost is lower long-term returns compared to something like stocks. You also have to think about other risks like rising interest rates or inflation eating away at your earnings, and of course, the small chance that the issuer could default.
So, with those trade-offs in mind, let's put it all together. How do bonds really stack up against other investments, and what role could they play for you? Is this IOU the right move?
This table gives us a fantastic quick snapshot. You can see bonds sitting right there in the middle of the pack. They generally have lower risk and volatility than, say, stocks or real estate, but they offer much better potential returns and income than just letting your money sit in cash. They really do occupy this unique middle ground.
So who is this middle ground perfect for? Well, bonds tend to make the most sense if you find yourself nodding along to these points. If you're someone who wants a steady, predictable paycheck from your investments, or you need to protect your money for a goal that's just around the corner, or maybe you just want to smooth out the roller coaster ride of your portfolio, then bonds could be a really great fit.
Now, if there is one single thing to take away from all of this, it is this right here. It's the power of bonds as a diversifier. And it's not just that they move differently than stocks. Think about it. During a big stock market downturn, investors panic. They flee to safety. They sell their risky stocks and buy up safer things like government bonds. All that demand can actually push bond prices up, providing that vital shock absorber, that cushion for your portfolio during those tough times.
And that leaves us with one final thought, a question for your own financial strategy. Take a hard look at your investments. When the next market storm inevitably hits, do you have that shock absorber in place? Is your portfolio missing its cushion?